Good morning and welcome to this Monday, September 14th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Futures looking pretty strong this morning. We're going to get into that in just a moment, but I do want to point those of you who may be new to Earnings Beats over to our homepage. We do have a free newsletter. Love to have you join our community if you're not already a part. The Earnings Beats Digest, you can see it here mostly in the middle of the screen. All you need, your name, email address, hit that subscribe button, and Mondays, Wednesdays, and Fridays, we will deliver our digest newsletter to you. Really, a lot of different topics that we cover. Sometimes it's on the S&P. Usually it's on individual stocks with focus on relative strength, earnings, and so forth. Just give you a little bit of a taste, I guess, of how we look at the market and how we try to beat the S&P 500. So it's just some tidbits 3 times a week. I think it's a really nice newsletter to learn more about us and maybe improve your own technical analysis skills. But again, just type in your name, email address there, hit the subscribe button, no credit card required. You can unsubscribe at any time. But I think it's a great way to maybe learn a little bit more. We do try to emphasize education in just about everything we do at Earnings Beats. You can see right now over here, we do track our portfolio, let everybody in public know how we're doing relative to the S&P 500. We try to be very transparent. And the current quarter's been a little rough, no doubt about it. Money has rotated more, especially here in September. It has been rotating away from growth stocks and into value stocks. And I can tell you our portfolios are made up mostly of growth stocks. I still believe growth is the way to go as we go forward. But the last couple of weeks, we've seen rotation away from growth and into value. And a couple of our portfolios, especially the model portfolio and the strong AD portfolio, both of these got off to a pretty good start this quarter, and they have now moved back behind the S&P 500 for the quarter. But you can see our since inception portfolio results on all these portfolios as well. And if you want to learn more about these portfolios and our chart lists and the things that we do for our members, you can click this Join Today button. There is a no-cost trial for 30 days. You pay $7 up front, but we refund it to you. And so you have 30 days really to enjoy our service. So check that out. Moving on to the market. From Friday, we saw the Dow Jones finish up 131 points. S&P was flat. NASDAQ was down 66. So that is bifurcation. That's the poster child of bifurcated market. We've got the Dow rising, the NASDAQ down, the S&P flat. Mid caps also down slightly, small caps down a bit more. Both mid caps and small caps now trading below their 50-day moving average. We saw the NASDAQ close at 10,853, also just slightly below its 50-day moving average. This was actually the first time we've tested the 50-day in quite a while. We went down, tested the 50, came back up. You can see on the NASDAQ here, tried to get through the 20, couldn't, and now moving back down. This looks to me like an ABC correction with us being in that C stage right now. But futures currently are pointing higher. Again, we'll look at some of those charts in just a minute. But I wouldn't be surprised. I mean, we're in September. I've been talking about this. I think this is going to be a month of consolidation and basing. And so trying to figure out exactly, how far we could go down. I wrote an article in the Chart Watchers newsletter this past weekend, and I talked about 3 different ways to look at downside targets on the S&P 500, or at least 3 different ways that I look at potential downside targets. And so if you're interested, you can go in and check that out. When you're at stock charts, just go into articles. In fact, I'll show you how to get there. So you click on the articles. If we get it to come up. Anyway, once you click on the articles, it'll take you to the article page. There you go. And on the drop-down menu, you can go straight to Chart Watchers, or since it's been recent, I think if you scroll down, you can look for the headline, Chart Watchers, and then you can look for the article that I wrote right here. 3 ways to calculate the S&P 500 downside targets. And this is the way I was looking at it. Now, this is an hourly chart. So you got the nice channel. And what I do is I connect the highs. Once you start pulling back, you know where the highs are. You don't have to guess where the highs are. Big high was back in June, another big high just recently. So that's a trend line. Take that, drag it down to some prior lows. You can see this was the low in May. Here was the low in June. And so I just used different lines. So these could be support lines if we're going to be in a channel down the road. So with this selling, you know, here's one comes in just about 3280. Here's one that comes in a little bit below 3200, but it's rising every day. You can see recent lows come down to 3200. So this is a zone that I'm looking at really based off price support and these trend lines. That was one way to look at it. So based on the 60-minute chart, I was looking at 3200, 3300, maybe is kind of where I would expect. Then if we look at Fibonacci retracement levels, if you take the low that we saw, here was the high in June. We came back, put in that reaction low. And from there to the top recently, if you take a look at that rally and then draw these retracement lines, you can see 33.48 is the first one. We were trading just below that. The 50% level is 32.74. I would suspect that this area from 38.2 to 50 is where we're going to turn back to the upside. Not, you know, I think a worst case scenario maybe would be that 61.8, which coincidentally 3200, just like we talked about on the 60-minute chart, and that trend line. So this trend line coming up right around 3200. Keep in mind that would also represent a pretty significant 61.8% retracement off of the last rally. And then finally, I look at the big picture. So, you know, you look at hourly charts, you get so caught up in the day-to-day. I think it's a good idea to step back and get a bigger picture look, and just what the market historically does when you're in an uptrend. If we look back to the last really big rally that we saw, extended rally, which I think we could be in, we look back to 2012 into 2013, 2014, and once we made these moves up, these pullbacks held the rising 20-week EMAs. You can see multiple. I counted 7 different tests of the 20-week moving average. I mean, maybe we went just slightly below, but for the most part, we were testing, approaching, or bouncing right off of the 20-week EMA. 2017 was another big move up, and when we pulled back, you can see we did a pretty good job bouncing off the 20-week EMA. Now with this huge rally that we've seen since March, we're pulling back. That first 20-week EMA test is at 3216. So I think that, you know, just looking at all of this, you know, my conclusion as I looked at all this was that we could continue to consolidate base, but I think this 3,200, 3,300 area on the S&P 500 is where we're going to see, you know, anybody selling out from recent highs, you know, we're buying in at the highs, 3,600 on the S&P. I think those folks, when we get back to 32, 3,300, they're going to be down 10%. That is, you know, probably an area where they'll start to panic, sell out. You got institutions ready to buy. And I think that's where we base and move higher. Now, I'm not saying absolutely we're going to 3,200, but you have to plan. You have to look ahead and say, okay, if we pull back a little bit, it's not the end of the world. It's not the end of the bull market. Even if we go below 3,200, I'm not saying it's the end of the bull market. But in a normal test of key support areas, I see 3,200 to 3,300 being pretty important. So go back and check out this article if you haven't already. 10-year Treasury yield today, let me give you the latest. It is down a little bit. We're down 1 basis point, 0.66%. Not really any economic news out today that I saw. So I think the market is just kind of, you know, we're not really doing much, not really moving much. I suspect after our gap up this morning on equities, I think we're probably going to be somewhat lackluster again. There's not a lot of earnings reports out. There's not a lot of economic reports out, certainly none today. And so as a result, I think the market may just kind of, you know, trade sideways. We may see a little bit more of the rotation that we've been seeing. But let's see what happens after the open. I think the open is probably going to favor the growth stocks. It looked like the NASDAQ was doing a little bit better than the Dow and the S&P. But I think once the market opens, I'm going to be watching to see how growth versus value trades. And I'll show you a chart on that in just a minute. Before we get into that, let's move on to talking technically. I wanted to get into the S&P 500 here and just show you some of the things to look for. You know, I mentioned back on September 2nd that I thought the first crack in the foundation was when Apple fell. The S&P was trying to go higher, but Apple was falling. That was on September 2nd. That was the day before the overall market started to drop. But if you look at this last move up, first of all, here's the S&P moving up, and here's technology leading the S&P, the upside. That's what you want to see. Notice on September 2nd, that same day I mentioned Apple was weak, there's the S&P really going up, very solid day to the upside. And look at the relative strength. All of a sudden, technology falling out of the bed. And that is generally not a good sign. When you're having that strong of a day, you know, you want technology to at least go along for the ride, you know, maybe a flat day. But we were actually on a relative basis underperforming on what appeared to be a very strong day. And also I wrote at that time, September 1st, September 2nd tend to be the two strongest days of September. And once you get past that, the rest of the month, since 1950, the annualized return from September 3rd to September 30th, minus 8%. Doesn't mean that September goes down 8% over those 28 days. That's the annualized return. So it's almost 1 month. So you could probably take that 8% divided by 12, kind of give you an average. So the S&P from the close on September 2nd to close on September 30th, average is going down roughly about maybe 2/3 of 1%. Okay, so the S&P 500 at 3340, you think, well, 2/3 of 1%, what's that, 20 points? That's nothing. Well, except that most months we go higher. So it's just that there's a little bit more of a tendency for the market to struggle in September. So as we've been pulling back, I wouldn't be surprised to see a little bit more consolidation. Maybe we go lower, a little bit lower, and then rally, I think, toward the end of the month. I think as we start moving toward October, I believe the stock market's going to rally again. And into October and throughout the fourth quarter, I look for new highs. I still think there's an outside shot that the S&P 500 hits 4,000 in the fourth quarter, which would be pretty amazing because that's what I predicted back on January 5th when we had our Market Vision event, and that was pre-pandemic. Some folks asked me after we hit the pandemic and the S&P went down to 2,200 if I was still forecasting 4,000 on the S&P 500. And then, of course, I was saying no. I mean, you know, no, I don't think at that point anyone saw this pandemic coming. So of course not with the new information. But here we are 6 months later, and the S&P 500, I think, does still have a shot, unbelievably, at getting to 4,000 this year. But that's a secular bull market for you. Same thing in 1987. I mean, not quite, we didn't have the recovery as fast back then, but that, I mean, the lows that we saw initially with that big significant drop, the market crash, Black Monday, October 1987, that was it. We never went back down below those lows. Very similar to what we did in 2020. It's just that 2020, we've come back a lot faster. But we had a very strong economy heading into the pandemic, and I think now we're starting to see that economy pick back up as more and more parts of our economy reopen. All right, this particular chart, though, the S&P 500, as we've been moving down, check out some of the areas. And I just like to see visually the money that's rotating. You can use RRG charts, which I think are great in terms of visualizing the movement. But this, keep in mind, is just the last 9 or 10 days, maybe 7 or 8 trading days. So if you're looking at the RRG and you put it on a weekly chart, you're not going to see this kind of rotation. And I think you can only do daily and weekly for RRGs. You can't do hourly, at least last time I looked. I don't believe you could do hourly. So this is more of an hourly look at the rotation. But technology's not been strong. But look at the consumer discretionary. Consumer discretionary actually has been outperforming the S&P and continues, in my opinion, to be, if not the strongest, one of the strongest groups in the market. So I'm very encouraged by consumer discretionary continuing to do well relative to the S&P 500. Communication services, this group actually topped all the way back here in late August and has been pulling back. I'd like to see that trend line break. But for now, that's not the situation. Financials versus the S&P 500, we're starting to see better action here. Financials have been moving higher. Industrials, very nice action here in September on a relative basis. So, when I say that it's been a rough first couple of weeks for our portfolios and the growth stocks, the good news is that money, while, we've been selling off in some areas, we've got other areas, other aggressive areas that are actually starting to do much better on a relative basis. I really like this. I think this confirms what I believe in terms of the market moving higher. If all this money, as the S&P was going higher or trying to go higher, next rally, I think it's going to be really interesting to see what happens during the next rally on the S&P when we go up and we break out above 3,600, which I think we're going to do. Watch these individual sectors on a relative basis to see which ones are leading. Okay. I also have, let's see here. Did I put it in? I thought, let me go forward. I think I can pull up. Did I save it? I think I did. Yeah, here are the other groups. Okay, so I just did the aggressive group. So now let's take a look. Here's healthcare. So when the market topped back at the end of, the end of September 2nd, but toward the beginning of September, you can see healthcare has been leading, consumer staples been leading, utilities have been leading, real estate's been leading. These are defensive areas. Some people would look at this, I know, and say, well, we don't want defensive groups leading. This is bearish. Well, defensive groups lead when the market is selling off. Remember, S&P's been coming down during this period. This is typical action when the market sells off. What you don't want to see as the market rebounds, I don't want to see these groups continuing to go up while technology goes down and consumer discretionary rolls over and communication services stays weak. That is not what I want to see. That would make me a little bit more nervous about the intermediate term. But it's too early to call that. Let's see what happens when we get a rebound. But this is also a good chart, I think, just to keep in mind. Look at materials. Materials continuing to be very strong. I think it's a combination of things. I think it's a combination of the rotation that we've seen out of technology. I think it's a combination of the fact the dollar has still remained pretty weak. After years, 9 years to be exact, of the dollar being in an uptrend, it now has been downtrending, and that's enabled materials to do well on a relative basis. Whether that holds long term, and I'm talking, more than just a few months, is it going to be something throughout the balance of 2020 into 2021? That's maybe a little early to say. But if the dollar continues falling, I would look for materials to continue to be one of the leaders. All right, so at least in the short term, you can see the downtrend that we're in. Now, we've got futures up, so we're going to see a bounce here in the S&P 500. Let me see where we are right now in terms of futures. Right now, the S&P is up 39, 1.17% futures. So, I mean, if we get, say, up even 30 or 40 points, that would be 33.70 to 33.80 up in this area. I mean, we've still got highs, recent highs to negotiate. You can see the low, the reaction high, the low, the reaction high, new low. Maybe this is going to be another reaction high before perhaps another low. I wouldn't be, overly excited by what's taking place. I will say this, if the market is going to bounce in September, I think it's probably going to be this week, just because middle of the month, we tend to see more money come in. Today's the 14th. I think we could be seeing, portfolio managers, hedge funds, so forth, that follow money flows. They could be getting in a little bit here, maybe going to ride it for a couple days, get past the 15th. The third worst week of the year is coming up, though, September 21 to September 27. Once we get past September 27th, mostly we're bullish until year end, even into January. The one exception is about that fourth week in October that we'll have to watch. That, of course, was, Black Monday, I think, was on the 19th. And that kind of starts, we always talk about the 19th through about the 25th, 26th being the worst time of the month for stocks. So we've got that, to worry about as well. But the 21st to the 27th tends to be the worst period for the S&P 500. At least in September. Like I said, I think it trails the October period, and it also trails July 17th to the 24th. Those are the 2 weeks during the year that since 1950 have been worse than September 21st to the 27th. So just keeping that in mind, and that doesn't mean we go down every year 21st to the 27th. Don't misinterpret what I'm saying. But the tendency is for the market to struggle then. And if we are struggling then, just keep in mind, maybe toward the end of September, we're going to put in a really definitive bottom. Okay, let's take a look. I talked about growth versus value. This is a 6-month chart of the IWF versus the IWD, growth versus income, growth versus value, maybe another way to look at it. But here you can see we've been in this move to the upside, but we go through periods where the growth underperforms, and that's what we're in right now. And so when I talked about our portfolios struggling in September, this is the reason. I mean, the rotation, it's going to happen. Money is going to rotate. What we don't want to see is money rotate for the next 3 months and this continue going down, down, down. That would not be good for our portfolios. Probably wouldn't be good for a lot of stocks on many of our chart lists, because those definitely have more of a growth-oriented feel to them. All the chart lists. Well, most of the chart lists. I think the short squeeze chart list not going to have too many of the growth stocks in there. All right, but anyway, to the downside, you know, you can see once we start trending up and we get above the moving average, this 20-period moving average, and that's above the 50, that's when these growth stocks tend to do the best. As long as once they move above that 50 and they stay in that uptrend, that's when you're going to see the biggest moves from areas like software, semiconductors, computer hardware, Apple, of course, automobiles with Tesla, the retailers, broadline retail, specialty retail. Many of these growth areas are going to be doing much, much better. Many of the stocks will be doing much, much better when we're in a period where this ratio is going higher. Right now, you know, I'll be honest, I think in the short term, we've got risk still until we start to see this change. Okay, let's move on. I want to go through and take a look at some of the industries. So I thought what we would do here, I've got the industry summary up. I've got all of the groups set up in terms of scooter order. So when we look at communication services, you know, I was showing relative weakness and the way that's been playing out for a little while now. Well, when you look at the scooters of the various industries within communication services, you can see Internet's the only one really that has a decent scooter score. So Internet's trying to carry the group. So when we look at the Internet group, look at what's happening in September. There's the growth theme. That's, you know, money's rotating away from it right now. You can clearly see that in the Internet stocks. But we were very overbought. I mean, it's okay to pull back when you're moving up to new all-time highs, and it's, you know, in the short term anyway, almost parabolic. It's okay to pull back for a little bit of time. I wouldn't be surprised to see a move up, maybe a little consolidation, and then a rise right back up, maybe a cup forms. That would be something to watch for. Another thing might be a little bit of a bounce, another pullback, new low. Maybe we get a bullish wedge that then breaks toward the end of September, early October. When I'm bullish and areas that I'm really bullish about are pulling back, I look for patterns. I look for continuation patterns. It's too early. I mean, this is basically our first pullback. So I don't know exactly what's going to develop. Maybe we have a big move right back up to 2,700, and then we have another big drop, and we put in like a higher high and equal highs and higher lows. Maybe it's an ascending triangle that forms. Hard to say what's going to form, but I do expect that we're in a secular bull market. My belief is the market's going higher, so I'm going to be looking for bullish patterns in these areas. Okay, other areas of the market. How about the autos? 99.9. Kind of hard to get much better than that. So what's going on with the autos? Oh, September, pulling back. Common theme. Interesting part here with automobiles, we essentially pulled right back to the breakout level. We had this triple top from July, right at about 440. We broke out, went straight up, came back just about to 440. So I'm going to say this 440 area, which the 50-day moving average, 443, that's a key area that we want to watch. But I think autos are fine, but we're getting a pullback, which is healthy. I mean, we saw this really for about 4 weeks back in July to early August. Wasn't as steep in terms of the selling. It was more just sideways consolidation, but we did pull back. And anybody buying in July 13th up here at the high would not have been happy come August 11th, 4 weeks later, when, we were basically down 15% or 12% or whatever the number is. But in this case, when you're going up, you're coming back down, you go up, you pull back, I would watch those previous highs. That's kind of the first line of key support. All right, let's see, what else do we have here? How about renewable energy? Take a look at what renewable energy is doing here. Oh, September, pulling back. I think you're kind of seeing the theme. The best groups, the groups that have been leading us, are seeing some profit taking, which is okay. Profit taking happens. I wish that we would just go up every day. That would be nice. But when we do go up every day, like we were, this is what happens. We get some of these big, quick sell-offs that can be painful. So we got to pay the price for a little bit. But I still think renewable energy looks good. Watch this area. I would say 135 to 140. Got gap support, price support in that area. You've got the 50-day just a little bit above 140. If we were to go a little bit below, I'd be all right with it. Probably could connect these highs and then draw that same trend line below, kind of see where that comes in. But I'm assuming it's, probably around that 140 area as well. So some of the areas, again, it's the growth versus the value. And last 2 weeks, it's been value. Growth is pausing, and we're seeing that on these charts. Earnings, not a lot of earnings coming out this week. I think FedEx reports later in the week. And there may be one other big one. I think it's Adobe Systems that reports later this week. But I thought what I would do is just show you, when I come over to Zacks, I just go into this earnings area, earnings calendar. And this is where I tend to follow the earnings. So here on the 14th, you can see with these 19 companies, I can come down, click on the market cap column, and just get an idea of Lennar reporting today after the close. That's a pretty good one. But nothing else really of any significance reporting after the close. Then you do it for each day of the week, kind of get a sense of, what's reporting. There's Adobe and FedEx both Tuesday after the close. There's going to be a couple big reports. Software, especially cloud, any companies, with cloud strategy, going to be interested in seeing what Adobe has to say. And then FedEx is part of the delivery services group, which outside of maybe autos, this has been one of the strongest areas. I think FedEx is going to blow it out of the ballpark. That's what the chart's telling me. Now, whether or not we get a big reaction to the upside is another story, but I do think we'll get a good report. Anyway, that's how I follow the earnings. I use Zacks. There's a lot of different websites that you can find out there that'll give you information on earnings. I just like to use Zacks, just personal preference. All right, let's move on to the 3 you must see, and then we'll wrap the show up. I'm going to start off with Laureate Education. And what I thought was interesting here, first of all, you can see the huge black candle. So the stock gapped up above 14, went all the way up 15.5, maybe higher, actually right at 15.46, pulled back down and closed at 13.29. That's a lot of selling after the early move to the upside. And I'm sure you'd see that pretty well in this 10-minute, 5-day chart as well. See the early move up and then the selling take place. Keep in mind, when everybody wants to buy, market makers are on the other side. So most stocks, not all stocks, many stocks though, when they gap up and all that excitement in the morning, and you got traders who don't really know much about what market makers do, they see all this excitement, they see it going up, It's a great way to make a ton of money. So they jump in at 15 and a quarter. And then at the end of the day, they're looking at their stock at 13 and a quarter and wondering what the heck happened. Well, market makers are on the other side. A lot of times you will get a pullback. This is one reason why I really am not a big fan of chasing stocks at the open. I like to see what happens afterwards, because when I see a black candle like this, it makes me think that probably we set a short-term high with this move up to 1546. And we're probably going to go back at some point and revisit the gap support down at 12 something. Now, at that point, it might be a great buy. But I personally, looking at this candle, have no interest in it right now. I think it looks to me like market makers are on the short side. They've got control of the action. Maybe we get a little bit of a move. Actually, we just opened, so we can see if we're getting a move to the upside. Yep, we opened up again. I wouldn't be surprised to see another candle. Now, if we can gap up and go through that 1546 level, that to me would be bullish. But I would have my doubts just based on the way it traded on Friday. Next up, Lyft. The thing that's interesting here on Lyft, so you can see it's up again here today. Look at the AD line. Notice how the stock went down and put in new lows from this July low to August, new lows. AD line's going up. We haven't broken out yet, but the AD line has. AD line's up at about a 7-8 month high. I think that's bullish for the stock. So if we get confirmation on a breakout above 3250, 3275, I think Lyft could be in for a nice run. So this is one I'd keep an eye on. TPR, Tapestry. This one broke out, but when I look at the AD line here, see the AD line is less than where the price, broke out from. That doesn't mean we're not going higher, by the way. It just means I would be a little bit more bearish or a little more cautious. I wouldn't short the stock, but if I was in it long, or if I got in long because of the breakout, I'd probably have a very tight stop. So if it couldn't hold this breakout, let's say it goes back down, closes below 16, that might be enough reason for me to get out simply because that AD line's so weak. Remember, this stock hasn't broken above the June high yet. So it's already a weak stock. I mean, if we look at the relative strength, it's one of the weakest clothing and accessory stocks, even though it's gotten a little bit of strength here of late. It's been in this downtrend for a while. And it's not like clothing and accessories has been a great area either. It's just kind of been middling, middle of the road for the last few months versus the S&P, not really doing much. So you've got a okay group, just kind of okay. And then you got one of the stocks that have been one of the weakest in that group. So yes, volume's picking up. It's starting to show some more positive signs. But this is the type of stock, because of these other warning signs, that if I wasn't overly confident, and I'm not, I would have to make sure I keep my stop in play, fairly tight one. All right, let's just go back now and check out what's going on in the market. We'll wrap up here. Dow up 183 points, S&P 33, NASDAQ 151, back over 11,000. I don't think we're out of the woods, like I said. I think that we're going to have a little bit more back and forth. I think that's what September is going to represent. Even as bullish as I am, I'd be shocked if the market just simply went up. Right now, I think there's just been a lot of technical damage on some of the growth stock charts, and I think it's going to take us a little while to repair that. Is it impossible for the market to go up? No, we're in a secular bull market. Of course, we could go higher. We could just shoot right up to new highs. I personally would like to see it base a little longer. I just think it would be healthier for the market. All right, that is it. So I'm going to wrap up. Thanks for stopping by. I'll be back tomorrow morning to do it again over at Stock Charts with my Next Trading Places live show. So tune in over there, 9 o'clock Eastern on Tuesday morning, and you can catch my next show. Everybody have a great day. Happy trading, and see you tomorrow.